Before we talk about 55.1, which sounds like a piece of string if you don't know how the index works, just give us, set the scene again and remind us how this works.
Sure. So it's an index that tries to measure conditions in the manufacturing sector. As you know, it's done in about 20 countries in the world, so we do the one for South Africa. The important thing is is the 50 line. So we want this index to be above the 50 mark. That tells us that manufacturing production or demand is increasing, and that is luckily where we are at this stage for the index. So at 55, I think one must bear in mind that in February the index, the headline was sitting at 57, which was a 2-year high. So it's taking a bit of a breather from that sort of very robust level, especially if you compare it with what's going on in the rest of the world. So I think it's probably a bit of a more realistic level that we are now at the 55.
You say that business activity and new sales orders, which are the largest weighted components in the index, were responsible for the surge in February and are therefore responsible for the pullback now.
Yes, that's right. So we saw about a 7-point decline, index point decline in the business activity index, which sounds a lot, but of course it's now coming from a very high level. So despite the decline, that index sitting around the 60 mark still tells us that there's fairly robust manufacturing production. And similarly for the new sales orders, which gives you an indication of the demand for factory goods, coming down, but again remaining at a level that says that there's still fairly strong demand. Probably most of that demand is domestically. We know the countries or the regions that we export to our manufacturing stuff, especially Europe. We know the story there. So this is probably more to do with pretty robust domestic demand still.
You have an interesting ratio, which I hadn't seen before in this, where you talk about business conditions declining by almost 4 index points to 62.4. And then the leading indicator, new sales orders, expressed as a ratio of inventories.
Yes.
So I suppose in sort of layman's terms, that's saying we've got so much stock, but the more we're ordering in relation to our present stock, the more optimistic we are.
Well, yes. So if your inventories are pretty low compared with the demand for your goods, it means that in the next couple of months you will actually have to ramp up production, right? To actually meet that demand. So that's why historically it has proven to be a fairly nice forward-looking indicator of where the PMI is likely to go.
Price index declined for the third successive month. What's the importance of that?
Well, it remains at a pretty high level of around 72. So it's still telling us that the rate at which input costs are increasing is pretty high. But the important point is it seems to suggest that rate has peaked. So we've reached the sort of highest level. It's very much in line with what we see with PPI from Stats SA. So back in October last year, that was increasing around 10% year on year. The numbers for February was closer to 8%. So oil, of course, is a bit of a risk there, but it does suggest that we've reached the peak in terms of these input cost pressure, which of course is quite good news.
Although the news in the last couple of days suggests maybe we haven't reached that peak. There's electricity coming through, and they say that the increase will be lower than expected, but we can't be sure. Water, other infrastructure type costs, doesn't look so good.
Look, I think on the electricity side, that has already been priced into most forecasts for PPI, for example. And of course, we actually got a bit of a positive surprise there that we were thinking of 25 and now it's 16, because 16 is still high. But I think the latest news on the petrol price, for example, the 70 cents we're seeing this week and some of the other costs you've mentioned, certainly, I mean, those are providing upside risks to this sort of moderation. I think the big one is what happens to the oil price. If that remains at current highs, perhaps even goes a bit higher, I mean, then we're in a different ballgame.
Because that's one of the prices that does go up and down, unlike many other prices which just go up.
Correct.
So it's hard to predict.
Yeah, no, and I mean, in the current environment with all these geopolitical uncertainties, it's almost impossible to predict. I mean, it can go either way. I mean, if there's a quick resolution on the Iran story, which is probably a bit unlikely, but I mean, you can actually see the oil price come down. And of course, given how fragile the world economy is, the longer the oil price remains at these levels, the higher the possibility that it might actually come down sharply, given the negative impact on demand.
I remember the time when it was at 150 and people said it's got to go to 200, and it never did.
Exactly right, because you kill off demand, it collapses, and then you have a price correction.
Particularly when producers are able to control that supply. Expected business conditions, a measure of how people feel about doing business generally, and I see your numbers there went down from 65 in January to up to 66 in February and down to 62 there.
Yeah, so again, this ties in with the leading indicator. This is what do people expect business conditions to be in 6 months' time, so a bit of a forward-looking indicator. Again, coming down a bit, but the level of the index still pretty high, still suggesting that people or our respondents actually expect things to improve over the next 6 months, or at least, let's put it, not deteriorate a lot from where we are now.
Yeah, and you seem to sum it up by saying it's favourable, but not necessarily very optimistic.
Correct, 100%.